Hello, welcome back to my channel, Value Investment with Manan Shroff. Today, we're going to discuss about Docusign. I have this company in my portfolio, and we do quarterly analysis just to give idea how the company is progressing. And also, one of the member asked me about analyzing current Docusign price. So today the Docusign earning was good. Earning was regarded good by investor, and that's why the Docusign stock was jump in after hours about $10 to $11. So we will look into what would be the good price to buy the Docusign and how much can we pay. So this is a disclaimer page as usual. This presentation series is created and maintained for educational purposes only, not intended to constitute legal, tax, accounting, or investment advice. All investment strategies in investment involve the risk of loss. Nothing contained in this presentation should be construed as an investment advice. So with that, let's move down to the Docusign. So if you go to the Docusign, if you don't know about the Docusign is the digital signature provider, digital signature platform provider. And you may have used it to sign up the refinance your home loan or any other sort of legal work. I really like the company for the one reason that it makes job very easy for the both for the customer as well as the service provider. I like that. These are the companies, though they are different, and we can just think about it that they can expand very quickly. I believe the Docusign provide a lot of service into more than one country, but they can always enter into the new markets very quickly. And when you think about Asia, where still the document process is done with the physical papers, we can say within next 10, 20 years, many countries will adopt this kind of formation because it saves a lot of paper. And also the Docusign will offer you the cloud management. So it will keep records of all your documents on the cloud, so you don't have to physically keep the record. Excuse me. So that way, the Docusign, I really like the business model. One thing, for this type of company, we have to see the nearest competitor for Docusign is Adobe Signature, Adobe e-signature, Adobe. I have asked a couple of people who use the Docusign services. And what I found out that once you are Docusign customer, once your system is integrated with a Docusign, the switching cost is high. It's not like plug in and plug out. The switching cost is high. So people retains, people will keep retain, people will keep using the Docusign. There was so much, there's like people can use DocuSign in so many different ways. If you go to the DocuSign website, it will show you the categories. If you look for the solution or products, let's see. I mean, there are very well-known companies that's been using this, so there is no doubt about that. But there was one area where you can see different categories that in the, all industries, let's see. So DocuSign can provide service to any industry. I mean, so I like that aspect of the DocuSign. So this is a qualitative analysis. The qualitative analysis is really important. It requires your common sense. It's important because ultimately the qualitative will drive the numbers. So the first thing is DocuSign. It has a market leading position, market dominating positions. Once you get used to with the DocuSign, the switching cost is very high. People would not like to switch to another e-signature provider. So the third thing, that if you think about the green initiatives by different countries, DocuSign fits into that model very well, because it saves a lot of papers, trees, and also it makes your storing and keeping documents safely a lot easier than the physical document where you require a lot of space. So all these documents are on the cloud backup with the high security. So it's like the perfect company for the next 20, 30 years. They should make more money what they are making right now. I also like the companies, they are based on the subscription. So they have the recurring revenue rather than one-time purchase kind of. So in that also, I have pulled the DocuSign. Let's see if I can see here. Okay, so here you can see the revenue contribution. The subscription revenue provide 97% income. So I like that also. You can also see the revenue has been jumping. So of course, in fiscal 2022, which was last year, and I think there was a huge sales increase because of the COVID, and people were working from the home. But think about that also, that in the fiscal second quarter, they were making 512 million. Now they are making 622 million. So whatever the growth that extend into the COVID, it's still keep extending. It's not going in the negative, like it's not showing up as a -5%. So that is very good. Like there was explosive growth between fiscal year 20 to fiscal year 2022. But that growth, on top of that, they are adding 22% quarter growth, which is nice. So all these things, we have to just now decide what price we want to pay for the DocuSign. And I have the DocuSign, I believe I have the 5% of my portfolio. And my average cost is about $92. And I'm going to keep DocuSign for long term, no doubt about it. I like the functionality. It makes work a lot easier. So with that, we go to the numbers. So when we go to the numbers, you can see here, it jumped 18% in after hours because the numbers came good. Basically, here is the thing that they beat our top line. We are right now looking at the top line because they don't have that much earning. So really, to evaluate this company, it's only one metric we have. It's enterprise value to revenue, and look at their cash and debt balance. So cash and debt balance is good. They are there is almost 1 billion cash, and the debt is only 872 million. So that they have a very good balance sheet. We see this return on asset equity all negative because still they are not making money. I mean, in the terms of earning per share, is still negative. But if you look here, so this is our enterprise value to revenue thing, because that's the only thing we have right now that we can evaluate this, how much we want to pay. Let's say tomorrow you want to purchase the entire DocuSign, how much will you pay? You know, like most people, they don't think about that when they buy stocks. They think that they are buying only 100 stocks, so it doesn't matter, they can pay any price. But whenever you're buying stock or any asset, you should buy near the fair value of assets, because otherwise it's not good if you don't. First of all, you have to know that what is the fair value of asset, and then try to buy close to the fair value of assets. So like people sometimes argue with me that, oh, I'm only buying 100 shares, so it doesn't matter, right? The valuation is entire company valuation. I'm not going to buy entire company. I'm going to buy the part, only 100 shares. So if it's, I don't have to know the value. Why would I know the value? Why should I know the value? I'm not going to buy the whole company. Well, that's why 95%, more than 95% investors lose money in the stock market, individual investor, because they don't know the value. So coming back to the DocuSign, okay. I looked on the DocuSign. Now, remember I said most time I don't like to pay more than 10 times enterprise value to revenue for these type of companies. Okay, so enterprise value to revenue is 4.85. So it's very good right now. You can see the difference. See, in April, so just 1 year ago, enterprise value to revenue was 27 times. Right now, it is under 10, under 5. I mean, so it's a huge discount. So what we were thinking about, that we never want to go above enterprise value to revenue 10 times, makes sense, because sooner or later, market will bring stock back to the bottom, you know, and if you have paid too much here, 27 times, you will be underwater for a long time. Now we have to decide that how much more we can pay. Right now, 4.85 is around $58. Okay, so if you want to know about how much more we want to pay, I looked, the one thing I noticed recently, with all these companies. And I want to show you that if I can go to their earning. Okay, let's see if I can go to DocuSign, and then let's go to, we want to find it out, investor relation here. I've been noticing this with a couple of companies, and that's, I have to rethink about assigning enterprise value to revenue ratio or earning per share price multiple going forward. I will show you why. If we go to the, let me see if it's here. Okay, so it's a DocuSign earning is here. All these numbers are very good. If you cannot see it properly, I have zoomed it. So all these numbers are very good. The thing what I have noticed with not just with the DocuSign, with all other companies lately, that I didn't like this part. Will show you. In the cash flow statement, what they do is a stock-based compensation expense they are adding, right? I mean, they've been adding it. So basically what happened that the stock-based compensation expense, many of you know that the company issue the options which you can exercise within 2 year, 3 year or 5 year. Many times ago, I mean, long time ago, companies were not bothered to report this as an expense in the income statement. So if you go to the income statement, usually probably under operating expenses, they have added this option expense, which is a non-cash expense. Okay, it's here. It's a stock-based compensation expense, including in cost and expenses, right? So what that does is that it's a non-cash charge, but it's actual real expense to the company. It's a real expense to the company because what happened that you are diluting the shares, and plus it costs the company to give you the option. So somebody is giving you on the option, if it's worth 1,000 share for $45,000, somebody is giving you, even though it's non-cash. When you execute it, it makes the shares more diluted, and it affects the shareholder value. So it's a non-cash expense, but in the free cash flow, when you want to calculate free cash flow, when you calculate net cash provided by operating activities, all companies been adding this back into the cash flow. So this is a huge amount. See the 141,207 million. Okay, so if you look on the 2021, 3 months ended, the option expense was around 100,000. It jumps 40%, right? And why it's jumping so much? It's my understanding is that it is hard to keep employees nowadays. The only way you can keep the employees or retain the employees by giving them stock-based compensation, But stock-based compensation going to affect your, it is real expense. It's going to affect your bottom line sooner or later. So we have to think that multiples, which we were trying to give price to multiple 30 times, a different way, because you will see the difference here within a 1 year, that now more and more companies are leaning towards the stock-based compensation expense. And so what happening that it will affect us as a shareholder. Many times what I like about, if the stock is, if the company is buying back their stock, so you can see here, repurchase of common stock. Okay. So they have issued 141,207, and they just have buyback 25,007 common stock. So if they buy back 141,207, then the effect is zero. The stock-based compensation expense is zero. So now we have to think about differently. So before we were usually giving enterprise value to revenue 10 times, now I have to think differently. I'm going to reduce that ratio. Why? Because of the stock-based compensation is jumping. It's jumping 40%. I have seen this with DocuSign, with Zoom, with Twilio, and many other companies. I mean, there are companies that have a balanced compensation, stock-based compensation. But in case of DocuSign, I didn't like this, because it's quite a bit. It's quite a bit. So we have to add the margin of safety. I like the business. I like the revenue. I like everything else. They're growing 22%. But now, because they are heavily compensated their employees with option, which many people cannot figure it out from the income statement or free cash flow until you dig into it. So I'm going to do now enterprise value to revenue 7 rather than 10. Okay. If I say the option expenses is huge, then I have to trim down the enterprise value to revenue ratio or enterprise value to EBITDA ratio. If I can apply that, enterprise value to EBITDA, I cannot apply here, is 1.32K. So I have to trim down now enterprise value to revenue ratio. So I'm going to trim down to 7 times. So any times, if I look into the cash flow statement and if I see they were giving huge amount of option compensation, we have to add the margin of safety and we have to trim down our enterprise value to revenue. So in this case, we would, I would rather pay enterprise value to revenue 7 times, right? So in order to, now we can go to here, and that DocuSign is forecast 2.57 billion for this year. Okay. So what we will do is we want enterprise value to revenue 7 times. So there 2.57 multiplied by 7 times, it's 18 billion. So what I'm looking here is instead of enterprise value close to 18 billion. Okay. That enterprise value, so let's see how many outstanding shares. They have the 200 million outstanding share. So if it's 18 billion divided by 200, the $90, up to $90 you can go, okay, up to $90. It's $90 is a peak, okay, it's peak. So if you ask me, can we buy on DocuSign right now? Yes, you can buy it. Even though tomorrow, if it's going to be $10 up, but at this close, as it going close to the 90, I will pull back. I will wait for the pullback because you are paying too much. I used to like this type of company because their free cash flow generated without much effort compared to other industrial company or commodity-based business. And that's why we were giving high multiples, enterprise value to revenue, enterprise value to EBITDA, or price to earning ratio. But since these companies have started to give to retain employee more compensation in form of options, we're going to trim down all these ratio so that we can have an additional margin of safety. So with that, I will conclude my presentation. You can buy tomorrow. It's a very good price right now, DocuSign, to get into DocuSign. If you don't have any position, it's really good good time to enter into the DocuSign. But I will stop buying above $80, and $90 is max for this 1 year. Okay, the value will change in next year, but the $90 is top. Don't go over $90. Right? If you want to purchase it, yeah, you can purchase tomorrow. Below 80, it's good buy. As you go closer to 90, it's not going to be that great purchase. So with that, I will just sign off. Please, if you really like videos, please subscribe to our channel. And I have told this in the past. Once I receive the 1,000 subscribers, then and only then I get a Google advertisement revenue, which I am planning to donate to the other people, needy people. So if you really like my videos, please subscribe. It's also helped the channel. It also motivates me to make more videos. With that, have a good night and bye.